The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Live Beginner's Course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
So let's move on then to discussing notional trade size. It is the overall position size value of a leveraged trade, wherein a small amount of invested money can control a much larger position in the markets. Accurately calculating the trade size is a crucial component of our risk management strategy. Okay. So again, that's simply affording us the opportunity, and that is of course why, and the real bonus to, I suppose, technological advancement over the past 15 years. Whereas, guys, trading the price of oil was once restricted to those on Wall Street or large, commodity indexes like Goldman Sachs. Now all of us can trade the price of oil, and that's a good thing. Let me tell you, that is a very good thing. But we need to know exactly what we're trading. We need to know how much of that that commodity we're trading as a leveraged product, how much leverage we are taking on, and to again consult lesson 2 there. It is essentially the risk factor or the amount of leverage we're taking in that trade. So because we can trade oil, doesn't mean that we want to just get involved because we believe something is just moving up crazy like Bitcoin. We across these more complex financial assets, they are moving all the time with news flow, with economic data, and we can get involved much more structured approaches to trading, of course, these investments. So accurately calculating trade size is, of course, crucial importance in terms of risk management strategy. You should be acutely aware of the notional trade size for each market you trade because, guys, they're all different. So here's a little table that I've constructed just to outline some of this for you. So let's just walk through some of these markets that we can trade, and I'll just use a pen to annotate this. So we have first and foremost the Forex markets. Forex markets, potentially I would argue the preferred markets given the amount of volume traded daily on these markets. The amount of volume, of course, is related to constant liquidity in these markets, and that effectively means that we can get a very good market execution at every particular price quoted to us. 1,000 of base currency is effectively the one standard lot. Okay, so again, if we're trading, again, I'll use a more common approach to the euro US dollar here. We're trading a one lot of euro US dollar. Again, the first what is called the base currency is our quote currency here, just the euro. Again, when we trade a one lot, it will look like this on the MT4 trading platform, and that is effectively a full 1,000 euro of currency in accordance to an appreciating or depreciating move in the US dollar. Okay, so I hope that is self-explanatory there. 100,000 euro. It's almost as if we have 100,000 euro of cash, and we are observing the fluctuating exchange rate of the euro US dollar. And we're able to cash in then at a later date if we're in a profit position, of course. That's effectively what we're trading there. So a one lot, then one mini lot is, of course, a fractional 10,000, and one micro lot is 1,000. So that would be more recommended, of course, to retail traders at this stage, particularly those with limited experience. So that there is effectively a 0.01 lot or a micro lot. Effectively, that is telling us that we are looking to trade 1,000 euros of cash against the depreciating or appreciating rate of the US dollar. Okay, so again, as we move across different asset classes, indices such as the FTSE 100, again, one lot there, one standard lot, is just a fraction of the one full index lot. Again, one mini lot is a fraction of one full FTSE index again, and the 0.01 lot. So effectively, these will move at different pip values, and we'll use our risk management software provided to Forex Academy as well to calculate how much exposure we are gaining when we access these markets. Again, if we look to trade a commodity like gold, we know how volatile it can be given its relationship to the US dollar. And well, it's a precious metal. It moves in times of fear and uncertainty across global assets. But here, did you know that one solid lot is effectively trading 100 ounces of gold? Did you know that? So again, even to break that down, one mini lot, which is something we can all afford with, a 500 euro account, we can actually trade. I'll just put that in there. We can actually trade one mini lot, which is effectively 10 ounces of gold. So did you know that the exposure from a small leveraged account allows you to trade 10 ounces of real gold? The effective value of 10 ounces of real gold, or even a micro lot, you can see 1 ounce of real gold. So that just shows you the benefit to actually trading, on a trading platform and actually looking to speculate across these assets. Um, you know, as I suppose in contrast to when you see your times of uncertainty come into the markets, you often see gold shops prop up on the corner streets, markets where a lot of people will cash out in the jewelry that they have, of course. Effectively, this is the same thing that we can gain a level of exposure in a commodity like gold. But again, we need to know the notional trade size that we are trading because it is effectively the risk factor in these markets. Our trading exposure then is, of course, concerning our individual exposure. It's the amount of capital you're risking in each individual trade. For example, 1% trade on 10,000 account balance, you're exposing $100 of your capital. So I'd like you to note it is very important that you're predetermine your risk, percentage risk per trade before opening a trade, because it helps you develop that level of objectivity. I'm going to trade the gold market here. I'm going to put 1% of my capital. Effectively, if this becomes a 1% loser, I'm going to lose perhaps $100, or for smaller accounts, I'm going to lose $10. Having the comfort before actually executing that trade will totally change the setup of the trade itself and give you when the more excuse me. One other point I would like to make more on the profit side is it actually changes the setup to an advantage for you. Again, you know that your risk or your stop loss effectively is $100 of the trade, but if the trade moves with you, then you know that the profit, you can gauge the level of profit as the market moves with you as well. So it helps people not just take those winners as they move into profit point. It actually helps traders try to run their winners, which is of course recommended strategy.